Ozan, welcome to the program. Good to have you on today. We have to begin with this major development we've seen in the Middle East. As we have seen previously, it seems as if risk assets are shrugging this off at this point. But take me inside how you're reading the situation. Is this a real inflection point for regional investors, or are we likely to see market stability continue to push through here?
Good morning, Dan. Look, we are in a world of slower growth, persistent geopolitical shocks, and capital that is moving with more caution but also with more concentration. Now, the Middle East sits at the intersection of these forces: energy, finance, security. So what happens here increasingly sets the tone of global markets. Now, what happened, of course, does not at all help the ceasefire efforts or the counter tensions in a region that is becoming increasingly more important, not just from a pure geopolitical play, but also as a significant focal point of global capital allocation, which, as you and I both know, is critical for global growth now.
Indeed, Ozan, and it's also interesting to look at the lifeblood of the region here as well. Oil prices still holding steady in the 60 to 65, perhaps 60 to 70 USD handle here. Are you surprised by the resilience that we've seen in oil?
Well, I think oil prices were always destined to be somewhat range-bound unless a major conflict spills over in the region and globally. So I'm not that surprised. However, let's also acknowledge one fact. Oil prices hovering at this range-bound level of, say, mid-60s all the way up to, say, early 80s. It may provide some stability, but not necessarily abundance. So we also witness Gulf surpluses are narrowing just as spending commitments grow. So the new challenge really is to balance the short-term fiscal needs with long-term diversification agendas of the region. But I'm not surprised that oil has not reacted as violently as some have thought.
Indeed, and because there's no immediate supply risk as well, perhaps the geopolitical risk premium hasn't necessarily been built in here. But at the same time as well, we've also just seen OPEC Plus signaling what's been described as quite a modest output increase for October. Of course, the focus of the group right now is ensuring price stability, knowing full well that these geopolitical tensions exist in the macroeconomic backdrop right now. What's your view on where oil moves from here and ultimately how that could impact fiscal balances across the Gulf as well, which directly translates to the investability of the region?
Absolutely. Look, I don't suspect that oil is going to have a major hike unless, as I said before, there is a major regional or global war, which I don't think we are going to have. Now, what this really means is that, look, the Gulf investors are now a critical, even a more critical part of global capital flows, especially as they become swing investors, if you will, in global markets. Now, what this really means is that not all Gulf countries are created equally, as you know. So Saudi Arabia requires a much higher level of sustainable prices to balance its budgets and also increase spending within the Vision 2030 framework, whereas other Gulf countries are much happier, or rather easier, until the oil prices hit maybe mid. I don't think we're going to see that. So I don't really see much movement in oil prices in the near to medium term, again, unless the increased tensions that we are witnessing in the Middle East becomes a much more persistent part of our life. Yeah.
Ozan, let's flip it over to what's unfolding in the United States right now as well, which of course impacts everything. We've just seen this tension between the White House and Lisa Cook continue to ratchet up. And of course, at the same time as well, we're now seeing new information about the state of the US economy and the labor market, maybe suggesting that things aren't as good as they appear. So what do you think this means for the trajectory of the US Federal Reserve and risk assets broadly, which have also been trading near record highs?
Look, it's obvious that the US economy is slowing down. I think this is more of a mid-cycle slowdown than anything more systemic. I don't think that the rate decision that Fed is going to take is anything but straightforward. I mean, there's a lot of confusion in the market. I'm not sure if we are going to get a significant rate cut to the tune of 50 basis points or more, maybe somewhere around 25 to 50, perhaps. But I want to take a step back then and also talk about another thing. Regardless of what Fed does, we are witnessing a time in history, in financial history, where cost of capital, both cost of equity and cost of debt, is going to rise and will potentially remain elevated for a while to come, as investors are finding it more and more difficult to price in the risks of long-term borrowing. And let's face it, it's not just the US, it's also most developed markets. Everyone is hooked on effectively some sort of fiscal stimulus. And investors are not really pricing in such long-term risks at the short-term part of the curve because they don't think that there's going to be a problem until there is one. Talking about risk assets, again, I think the AI story, the future of humanity story, the innovation story is going to continue to persist. But there is something to be said as well about investors looking to diversify their portfolios to hedge against what may come in the future, which is much more about real assets and certain sectors such as energy, infrastructure, and defense.
Okay, so Ozan, because you mentioned energy, I wanted to spin into that as well. We've spoken about oil, but let's talk about the policy reaction function out of the United States right now too. President Trump urging the EU to impose tariffs of up to 100% on China and India over their Russian oil purchases. Of course, we've already seen the US hitting India with these really significant 50% tariffs for its buying of Russian crude. If this 100% tariff on China and India actually takes effect, what is that going to mean for crude flows? What is it going to mean for the investability of China and India? And how do you see it reshaping your overall investment strategy if we saw these tariffs going up to 100%?
First of all, Dan, I don't think we're going to see 100% tariffs by anyone towards China short of paying the US. I don't even think we're going to see this come out of the US. The fact of the matter is, multipolarity is no longer a theory. US still remains the security partner of choice, but China is the trade partner of necessity. So all these words being thrown around I think are there to try to get a better trade deal by the US. And I most certainly don't think that countries are going to or can indeed impose 100% tariffs to China. Now, in a hypothetical, if they do, well, look, again, we need to get ready for a much more impactful shocks to the global supply chains, which I don't think is a place that anyone wants to see us go towards, and I don't think we'll get there.
You know, it's interesting as well, just looking at the tariff strategy out of the United States. We've seen the US actively trying to realign its trade flows in the direction of its own national interests. Is there an off-ramp here for the president, Ozan, or should investors just expect these measures to stay in place indefinitely?
Look, I think financial investors have gotten the sense and just that this sort of rhetoric is really the modus operandi for this administration, focused on trying to get a better deal for the US at the negotiation table. So most financial investors are now more comfortable pricing in the risk of this rhetoric. What worries me more than financial investors, Dan, are the real investors. The corporate boardrooms where decisions to invest and expand capex investments are being put on hold, are being slowed down because it's just so much more difficult to make an investment decision when this sort of noise is going on. And we may end up witnessing a lag effect of this that will reflect on the growth story of the world economy. But financial markets are not really having that much of a difficult time pricing in the rhetoric coming out of the White House.
Ozan, final question here. If these tariffs stay in place as they are and we see the Fed perhaps moving to a lower rate regime, what's your favorite trade right now? Where do you want to be exposed in allocating capital?
Well, I would like some protection against the potential debasing of the fiat currencies, and that really means a more stronger element of real asset allocation. At the other end of the spectrum, again, I am betting on innovation. innovation takes place in markets where there is the capacity to dream, to finance these dreams at as cheap as possible rates, and also a lack of bureaucracy. Finally, I'm betting on the structural requirements that are out there to support what I just mentioned. It really is energy, infrastructure, defense, food and water security are more as more midterm to long-term kind of thematic investments. I still think, given everything, that in the developed markets, US is the place to be, and I do think that Europe has a significant issue, a series of issues, again, not necessarily immediately fiscal, but much more about the bureaucratic nature that they have to circumnavigate.